Hi everyone, welcome to Awesome Strategies. In this video, I want to talk about how I plan to trade NVIDIA with option. NVIDIA is launching the next generation GeForce RTX 40 series GPUs, which touted as the most powerful AI-focused GPU the company has manufactured in October. The company's second generation OVX systems, designed for scaling up metaverse applications, also in full production. Unfortunately, the good news was overcast by the US government's restriction on export of the A100 and H100 to China due to military risks, and Chinese firms such as Alibaba, Tencent, and Baidu are some of the NVIDIA major cloud customers. At current quarter, COVID lockdown in China had reduced the demand from the Chinese hyperscale customers. This is the one-year chart of NVIDIA. The stock price has dropped more than 62% from its high on November 2021. The stock price is moving in a downward channel after reached the high on November 2021. Now the stock price is trading at 52 weeks low and riding at the midline of the channel. Looking at the chart with Bollinger Band, the current stock price is hitting the bottom of the band. My assumption is the stock price will keep moving downward or sideways until the macroeconomic conditions change. However, I think the stock is at a good valuation level and a strong potential to rebound once the macroeconomic condition changes. Remember, this is my assumption and it's not a trade recommendation. So, how can I trade NVIDIA from here? The first option strategy that I plan to use is selling a straddle and buying a call. This is a profit or loss profile of the strategy. The trade is set out by sell an at-the-money put option and sell an at-the-money call option, then buy a further out-of-the-money call option. The premium collected will be more than the width of the call spread. The reward is limited to the premium that I collected, and the strategy has no upside risk, which means I will not lose any money of the stock if the stock price jumps higher than the strike price of the call that I buy. Unfortunately, this strategy has unlimited downside risk. I will have to buy 100 shares of the stock if the stock price drops below the put option strike price at expiration. If the stock price does drop below the strike price, I can roll out in time and roll down the strike price of the put option, then sell another vertical call spread with the same expiration date to collect more premium and buy more time for the stock price to rise. If I'm not able to collect more premium with the rolling strategy, then I will buy the stock and start to sell naked call against the stock to further reduce my cost basis. The second option strategy that I consider to use is selling a broken wing butterfly. This is a profit or loss profile of the strategy. The trade is set up by selling at the money put option, then buy a further out of the money put option. At the same time, also sell an at the money call option and buy a further out of the money call option with the call spread is wider than the put option spread and the total premium collected is higher than the put spread width. In this example, the put spread that I plan to sell is $2 and the premium that I collect is $2.76. The reward is limited to the premium that I collected, and the strategy has no downside risk and a limited upside risk, which means I will not lose money if the stock price drops below the put strike price and lose a limited amount if the stock price increases higher than the call option strike price. The reward to risk ratio is high with this strategy, and the maximum reward is achieved if the stock price stays at current level when the option expired. Thank you for watching, and remember, all trades discussed in this video are not trades recommendation.